So hi everyone. Thank you for your time. Thank you for taking your time out to join us from your busy schedule at AIF PMS Experts India. We are thrilled to announce our brand new show, which is Ask the Expert Show. Through webinars, we aim to share insight into diverse asset classes, forecasting knowledge exchange among our investor community. So my name is Devanshu Bindlish, and I am the Vice President for AIF and PMS Experts India. With me, I have speaker Mr. Satish Kothari and Kshitij Kaji, who is CFA at Sageone Investment Managers. So let me take a moment and introduce Mr. Satish Kothari and Kshitij Kaji. So Satish brings about 18 years of rich experience and expertise in financial markets across sell side and buy side research, deep understanding of BFSI, consumer sectors, and build strong network of channel checks. Manage money for large family office during his propriety. He is a CFA holder, MBA from Symbiosis, and commerce graduate from St. Xavier's College, Kolkata. Now, little bit background about Kshitij. Kshitij also is a CFA, has 9 years of experience in equity research on sell side and buy side, enjoys identifying mega trends, focusing on qualitative aspects and behavior finance. He is also a CFA charter holder, accountant technician from ICAI, and Masters of Commerce in Management from Mumbai. So today the topic we have is how Sageone manages large cap and mid cap portfolio. So welcome Kshitij and Satish. How are you?
Hey, thank you, Devanshu. Thanks for having us. Hi, everyone. Thanks for your time. Thank you for joining us in this knowledge series. Our endeavor will be to take you through our fund, Sageone and Sageone Large and Mid Cap Fund, and what is our philosophy behind that fund, and how we have curated the portfolio stocks as such. So thanks for the introduction, Devanshu. Both of us have a combined experience of close to 3 decades now across buy side, sell side firm. Kshitij has been part of Sageone since last 3 years plus now, and it is now 2 years for me as well. We are part of the investment team apart from the large cap and mid cap fund which we manage. We look at overall investment ideas as well. Just jumping to our Sageone large and mid cap offering. SLMP, we call it. SLMP is a specially curated bottoms up portfolio of 18 to 25 high quality businesses which are rated by conviction. They are picked from the top 250 to top 200 companies by market capitalization as defined by the regulator AMFI. Our aspiration is to outperform available options in the category by around 3 to 5%, meaning generating excess return over Nifty, net of fees and expenses. This results in a targeted return of roughly around 16 to 18%, which implies doubling of portfolio in 4.5 years as such, with a relatively low risk. Now, we have a differentiated approach versus mutual funds. Now, if you look at the mutual fund overall, compare ourselves with the Nifty large cap mutual funds or large and mid cap mutual funds. Our commonality with Nifty is on the lower side, and as highlighted that we are more of bottoms up approach. So we look at businesses more from a growth perspective, more from a perspective of whether it makes sense to own those businesses, or rather than be driven by whether it is part of the Nifty or any particular index, and we should have certain amount of weight in that portfolio stock. So as of now, our holding as defined, again, top SEBI, AMFI defines top 100 companies as large caps, from 101 to 200 as mid cap. So if we take that definition as such, our large cap allocation right now is 75%, and mid cap allocation is around 25%. But if you look at the top five weight, and the top five stocks of our portfolio will be significantly different than what Nifty has, or what other large cap mutual funds have. So it is more driven by our conviction on those businesses, and we try to allocate a decent weight so that we can outperform and achieve our desired return as such. So this is what we wanted to highlight in terms of where we differ from large cap mutual funds, is one, through stock selection, and the other aspect is whether the right weightage has been allocated to that particular stock. On the left hand side, you will see that we have compared the rolling returns of large cap mutual funds and large and mid cap mutual funds and Nifty 50 TRI, and looked at it whether have these funds been able to generate significant alpha over Nifty as such or not. The data says that over a longer period of time, they have not been able to generate significant amount of alpha. So our endeavor is to generate 3 to 5% excess return through stock selection and through stock allocation as well. Now, coming on to our investment approach, our portfolio is divided into two investment buckets. One is the compounder bucket, which is a growth bucket, and the other is a tactical ideas, which are more of a value-oriented basket as such. So the compounder basket is around 70% of our portfolio, and what we are consist of companies likely to compound earnings at around 16% plus for the foreseeable future, and are assessed with various parameters such as management quality, opportunity size, and market share gain, operating parameters of these businesses. The tactical basket, which is around 30% of the basket of the portfolio, consists of companies where we feel that there lies a significant inefficiency in the valuation, and market is not attributing the fair value of the businesses. Market is not valuing fairly these intrinsic sound businesses. Now, we expect these inefficiency in the market valuation to go driven by certain trigger. That may be market consolidation, that can be new product launches by these set of companies, or can be a business transition which these guys are going through. Eventually, these transition will lead to significant change in earnings profile, which will lead to earnings growth, and street will reward it with a higher and a better valuation as such. So with the combination of these two baskets, our endeavor is to identify stocks and achieve our desired return of around 16 to 18% post fees. When we look at both these baskets as such, are one of the most important thing what we do at Sageone overall is look at earnings growth in a very, very close manner, because we feel that earnings growth is the key defensibility of the portfolio in any downturn as such. So when we assess any companies, we look at how the earnings will pan out over next 3 to 4 years, and whether the significant advantage or the significant moat which these guys have are more sustainable over long term or not. To get that and to achieve that, we give a lot of emphasis on the operating parameters as I highlighted. We feel that operating parameters have a uh, road, long way to create significant moat, and it leads to a more sustainable financial matrix over a longer period of time. So this is how we also differentiate our portfolio and assess the companies within the portfolio, both on the financial and on the operating metrics as such. Coming on to the overall comparison with the benchmark as such, as highlighted that it's more of a bottoms up portfolio as such. So right now, the lowest market cap of our company, or the lowest market cap in our portfolio company is around 40,000 crore. The average market cap can be 1,40,000 odd crores, and within the sectors also it might differ. It's the end result. We don't start with looking at whether this sector warrants this much amount of allocation or not. It's more of a stock selection which eventually leads to these kind of results. Uh, Overall, when we look at certain stocks, for example, consumer, which has gone through a significant amount of slowdown overall, but we have a significantly high weightage as such. So, and it has done exceedingly well for us. Given that, for example, we own Trent, we own Indigo as such. So these are the consumer names which are growing at a significantly faster pace than the overall market. So again, it's more driven by uh, overall overall growth of that particular stock, or the growth in what we envisage in that particular name, rather than driven by a particular index or as such. So, in a similarly, I think BFSI, we have 27% weight, but we have decent exposure to non-lending financials as well. We believe in that there is a lot of financialization which is happening overall in the country. So we own asset managers, we own general insurance companies, we own gold financials. So we are not limited to playing only through lenders, whether it is private sector or public sector. So this is the end result which is there. If we compare our valuation, our portfolio valuation with the overall top 200 market cap valuation, uh, we see that our portfolio has a higher earnings growth with a better ROE, and still is available at slightly cheaper than what overall top 200 companies as such is trading at. So this is one aspect which we wanted to highlight. Coming on to our performance till date, now we do agree that it is a short period of time. Now it has been roughly around 10 months since we have started managing public money. So you can see that from August 2024 to August 24 2023, we started taking public money. Uh, so the performance is there, but overall, we have been managing this fund since last 2 years, 3 months plus. We as a firm, we wanted to explore whether we have mm, whether we can deliver 16 to 18% return for in large caps as such. So the process started in April 1st, 2022. It was with our prop money, and over a period of last 2.5 years, we have gained a decent amount of knowledge. We have honed our process, and after looking at it for at 18 months, going through a lot of changes and iterations, we launched it for our public in August 2023. Just for your reference, we have highlighted that what has been the return since inception, and since we have started taking public money as well. Yeah, so it's for you to see. Now, for next section, I will just ask Satish to take it ahead. He will brief you about the commercials and how we look at markets. What is our view on the market for next, for near future and over a longer period of time.
Yeah, thank you, Satish, and yeah, thank you, AIF PMS Experts, and thank you to everybody who's logged in and for your time. So we'll just briefly touch upon the fee structure. So we've tried to keep this product extremely competitive with all the other available options that are there in the market. So of course there are passive funds that charge less, but those returns are similar to what the Nifty does, and the mutual funds which charge fees, as Satish highlighted earlier, that the returns or the extra returns that they generate over the Nifty are very nominal. So in spite of us putting in significant of our time and bandwidth into it, we've tried to keep the fee structure very competitive versus that of mutual funds. Also, the minimum entry point is 50 lakh rupees, while other Sage1 products are all minimum entries 2 crore rupees. And also there is no exit load in this offering. It's a very fairly liquid offering because it is only catering to large cap, so we feel there is no need to keep any exit load. And just on the commercial side, we've kept both the structures as an only fixed fee structure and an only variable fee structure, so investors can choose whichever one suits their criteria better. So that was just on the fee structure, and then just rounding off the presentation, with what is our view, currently. So if we see, on the large cap side, which is, almost 75% of the portfolio today, there the, multiples of the stocks, are close to around what has been the 10-year average. So, while the markets, seem at a, very high valuation, but the, average, at least multiple of the valuation is similar to what has been over the last 10 years. So, we also would like to, see this in terms of the growth that is there. So when you compare the current valuations with the growth, we feel that, these large cap companies at least, are not very expensive as such. They may be expensive, compared to what they were a few years back, but on an overall basis, they aren't. So if you take, say, Nifty, or you take the whole large cap universe, the growth that these companies used to be in single digits over say 2017 to 22 odd. But if you see the last 2 3 years, and if we even see the growth that's going to happen over the next 2 3 years, it's going to be in mid double digit. So we are seeing very strong earnings growth, and this is happening because investments are happening in a lot of different areas. So whether it's on the renewable side, or it's on the infrastructure side, or even in defense, the government is spending a lot. There's a China plus one that is happening. So on the electronic manufacturing side, there's a lot happening. There are PLI schemes. So with all this coming in, we expect earnings growth momentum to remain. And at the same time, what we've seen is that in terms of balance sheets, at least, whether it is the government balance sheet or its company balance sheets, etc., everything has been cleaned up to a large extent, and even bank balance sheets are also very strong. So given this entire context wherein things have been cleaned up, there are a lot of investments happening, there is underlying growth that is happening in these companies. We feel that going forward also, at least earnings growth for large caps also should be better than what it was, maybe that 2000 16 17 to 21 22 period. And given that the multiples are also fairly reasonable, we think that over a 5-year horizon, we should be able to achieve a 16 to 18% kind of a compounded returns, and that would lead to doubling the portfolio in 4.5 to 5 years. And just lastly, if you just think about large cap as a space, the flows that have come into the large cap space have been quite muted. In fact, we've seen more money going out of large caps and more into mid cap and small cap. And generally, the biggest investor in the large cap space are foreign institutional investors, FIs, but they've also been missing, and they've also not, been investing into India. So, in case we see a reversal of foreign investors coming into India, and we also see maybe some more activity from the domestic side happening in the large cap universe, then that should also help support these stocks. So overall, we as just to conclude, as Satish said, that from this entire universe, our objective is to focus on the operating metrics, find the best companies which we believe would do well over the next few years, and then adequately weight them based on our conviction, and then the returns would be an outcome of that process. So I think with that we've come to the end of the presentation, and we are open for Q&A. Thank you so much.
Thanks for giving your beautiful presentation to my investor community. So now we will wait for my investor community to ask some couple of questions from us, and we are open for the Q&A. So anybody has any question, please draft us in the chat window so that your questions can be addressed by these CFAs here right now. So we will wait for 5 minutes. In the meanwhile, I do have some questions with me which I personally wanted to ask. So Kshitij, can you Satish and Kshitij, can you tell me, what would be the best time horizon for your fund? So what should be the tenure if somebody is coming to stage one, and how much they should wait for the time? Give time to you people.
See, when we look at our portfolio process, when we look at our portfolio stocks where we want to invest, we have a time horizon of 3 to 5 years in the compounder basket as such.
Okay.
To fully play out those kind of investments, what our endeavor is that for 4 years to 5 years is the right approach. On a tactical side, what our endeavor is, it's not a short term thing. We want these stocks to undergo or a transition, which generally takes around 12 to 18 months, kind of a thing. And if these transitions are more structural and more sustainable in nature, these stocks can easily transform into more of a compounder stock as well. So as such, I think on an overall portfolio basis, ideally what we look for is slightly longer tenure kind of an outlook as such. But broadly, if you look at it, large cap space, top 200 stocks is fairly well discovered or a fairly well identified basket of stocks. So structurally, these stocks have lesser volatility as against other market caps broadly, if you have to say. So that aspect is there. So kind of it's very difficult to time as such, but just going with the investment horizon what we have, I think 3 to 4 years will be the right approach on a blended basis.
Sure. And the second question is that, as you know, the market is trading at all-time high right now. So what do you think people should invest right now, or how they should see this market?
See, I think Kshitij answered some bit of it, that what's our view on the overall market. We always look at that market is at all-time high, and our job is all the more difficult when the stock prices goes up, whether it makes sense to identify those new stocks or existing stocks as such. But looking at it from a perspective of all-time high and not looking at the strength of the economy at the same time is not correct. So when we look at all-time high, we have to look at it how well positioned we are in terms of growth, in terms of macroeconomic stability, in terms of cash flow generation, in terms of opportunity size as such. So when you look at these factors and then triangulate with valuations overall, on a historical basis, we may look at it that we are trading at a significantly higher valuation. But just to give you a broadly, I think Nifty is trading at around 22x FY26. I think at peak it used to be higher. but on an average, overall, it can trade at 18 to 20x when the macroeconomic stability and the overall growth was also not that much. We have doubled our EPS since COVID. For from 2014 to 2022, there was hardly any growth as such. We were growing Nifty EPS at around 5%. So broadly, we have to look at it. What are the things which are happening right in the economy as such? Kshitij pointed out that our current account situation, our macroeconomic, our fiscal position is quite strong. Our debt to equity ratio is at a significantly lower this thing. Banks are well capitalized. Banks don't have NPA. So from every perspective, I think overall India is at a decent pace as such. Has the valuations overall run up? Answer is yes. Now we may see bout of volatility. We may see some bit of correction. We are not. We cannot time it, and we cannot predict it as well. But overall, what we look at it overall 3-year period or a 4-year period, can we make money from here? Answer is yes.
So thanks for answering that question. So now I have a question from one of my investors. So he says that what is the view on NBFC in near future with implementing rate cut?
See, overall, if you look at NBFC space, I think it's a very broad space as such. We have housing finance companies, we have consumer finance companies, we have gold finance companies. So, and the dynamics are totally different as such. So, what we look at it from a overall broadly from an NBFC perspective as such, that whether it is able to uh, give the growth overall. What is our requirement or what is our criteria as such overall, and with a very robust asset quality as such. So we are very very conservative on the asset quality front and the quality of book which any NBFC or, for example, lenders have, because in a down cycle, it can be a significant drawdown to your profitability as well as the numbers. And when you witness a higher amount of NPAs, then your ability to grow also uh, gets significantly curtailed and limited. So we do look at we do like certain names in gold finance companies. We feel that these are the set of companies um, highly secured lending. They are going at around 17-18% kind of growth. ROE profiles are significantly better. One of the best managed gold finance companies. So we continue to like them. We have exposure to one of the diversified now NBFCs, one of the leading NBFCs where vehicle finance business is doing phenomenally well, and their entry into new businesses are also bearing fruit. So new businesses are tracking operating matrices where which has been achieved by existing players after a long time. So these guys are able to achieve that and at the same time deliver 25% plus kind of growth. So we do like, if there is any rate cut, obviously these guys will tend to benefit, because we have seen over last 18 months that the funding cost across financials has moved up. How much of it will be retained? It will be more of a function of competitive dynamics as such, but better NBFCs will be able to retain some bit of it. So, and we expect that our portfolio stocks will be able to retain some of it and reinvest that money in terms of growing at a higher pace.
So we have one more question on the portfolio side. How the portfolio churning will happen to generate more alpha, and how many stocks you are going to keep in this PMS offering? Overall, how much AUM managed by Sageone?
So,
Yeah, sure.
Should I repeat
yes,
the question?
Kshitij, please go ahead.
Yeah, just so on the churn, basically, see, as of now in this current portfolio, I think our churn has been, around 16-17%. But for the full year also, we expect it to be, around 20% going forward. And most of this will come from the tactical side. So as Satish was highlighting that, there the investment horizon is around 12 to 18 months. So there could be higher churn on that side. But on the compounder side, generally we hold for 3 to 5 years. So the churn, shouldn't be, very high on that side. So blended across both compounded tactical, churn should be around the range of around 20% or so. And just in terms of the total amount that Sageone manages, that would be close to around 6,500 crores as of today. And in this portfolio, we'll have, roughly 18 to 25 stocks. Yeah.
Okay, so now I have one more question from another investor. So what he's saying is gold financing and vehicle financing because they are likely to do well in NBFC space. What do you think about that?
Yeah, so I think I've briefly answered this bit of it that we do like, as I said, that it's a bottoms up approach overall. Uh, these these set of companies can grow at around 18 to 20%, and with a better management and a new business line, the vehicle finance company can easily grow at around 25 to 30% probably. This is our view on the set of companies what we own. Broadly, overall, if you look at it, credit growth of Indian economy has been in the range of over 15 odd percentage. So that will remain. Identifying better managed and better risk assessed name in financials is key rather than just going ahead with the higher growth type of companies. Maybe Kshitij, if you want to add anything on this.
No, that's perfect, I think.
So the next question is road constructions because they have done well in last 5 years. So what do you think about the growth on road construction side?
Yeah, so I think maybe in the at least large cap universe, there are really no, or even say in the larger mid caps, I don't think there's any road construction company as such. I think L&T is one company in the infrastructure space, but they're very diversified, doing a lot of things. But given that the government is spending a lot on capex, so I think infrastructure based companies are done well. But since there are no pure play companies in the large and mid cap space, in the road sector, I mean, there's nothing really to discuss because there's no company in the space. Satish wants to add something.
So broadly, the government focus remains out here. We do like the focus on capex and what the government is doing. If any stock which comes into our radar in terms of at our desired valuation, we are open to looking at it. May not be in this particular portfolio, but in our other two portfolios as such. So we like, but if the valuations are factoring in next 4 5 years of very high growth, then we will rather wait it out and not give that much amount of payment. So we have to, but we do like government's focus on this space as well. Overall, not only in terms of road construction, but on the overall capex side. The challenge for us has been getting it at a right valuation.
Thanks for answering that question. So now we have one more question, which says us how you see the market going towards in short term, like next 1 or 2 years.
Short term, to be honest, is very difficult to predict as such for anyone. But as highlighted that given the strength of the Indian economy, given the earnings growth, what we are envisaging and what we are doing, overall PLI scheme, higher capex, we can witness a higher amount of private capex now. Government has facilitated a lot of growth. So, given all these factors, the fiscal and the monetary situation remains quite benign right now. Despite global headwinds, we have been able to manage it quite well. Our inflation is under control. So, all these things doing quite well, or there are no complaints as such. So to take a call on 1 to 2 years or 1 year, we don't see significant given as things are, but short-term corrections and short-term movements are very difficult to predict as such. We have budget round the corner. We have already experienced some bit of volatility before election. So having a longer term approach will be better. Short term, it's very difficult for us to forecast as such, but as highlighted on the strength of the overall economy factors, be it company specific, be it macroeconomic specific. So overall, the risk is on a lower side in terms of any significant crash or as such, but we also do track all these things as you guys do. If there is anything negative or
Yeah.
on the adverse side for the overall country or the economy, we do take corrective action as such. So as of now, we don't foresee a significant amount of risk, um, apart from I think slightly higher valuation which is there, but mm, that's part and parcel of the game as such.
So, what would be your exit strategy from any stock?
So, having said that we are we when we look at companies from a horizon of 4 to 5 years, but we do track these companies on a very active way. It's a buy and watch strategy rather than buy and hold. If there is any derailment or change in the structure of our original investment thesis of any stock, we do take corrective action uh, and try to exit that stock. Uh, on the other side, if there is better opportunities which are available and at our desired valuation, then we might exit uh, our existing stocks to fund those names. So this can be another strategy when we can exit a particular stock. And as highlighted through the process, that the exit strategy, for our tactical basket will be different than uh, exit strategy of our fundamental or a compounder basket as such. There have been stocks where in our tactical basket where the why we bought it played out and we exited and we entered a new stock. So there was no problem or there was no issue as such structurally with that stock, but our thesis played out, so we exited. On the compounder basket, as we focus a lot on operating matrix, if there is any deterioration on the operating matrix side, which is more structural in nature, we tend to take that corrective action. We go deep into that name and understand that why it is happening, whether it is a short-term thing or more structural in nature. So, and take corrective action on account of that. Overall, as Kshitij mentioned, that our churn rate is in the range of around, you can say, 18 to 20%, not beyond that, which is on a higher side for tactical basket and on a lower side for our compounder basket.
So,
You are on mute.
yeah. So, what do you think? What are the sectors likely to do well in next 1 or 2 years, and how it can lead to rate cut? What sectors uh, to perform? So, this is the
Take
question.
it.
Yeah, sure. So I can take. So, see, I mean, as Satish highlighted earlier, that we look at it more from a bottoms-up approach. So we are not too focused on which sector will do well. So we are more focused on where, opportunities lies across various sectors. But just, having to, give some perspective maybe. So there are certain pockets, from time to time where we feel that maybe, things are improving. So recently, maybe over the last, 1 month, we had added little weight, to the IT sector. So, they had gone through a very difficult, challenging phase over the last, maybe almost 2 years. And we expect that maybe, things could get better there. So there are, a lot of sectors where, like IT or consumer discretionary, where things really, haven't played out. There have been a lot of challenges. In that, we've, always tried to pick the companies that would, grow irrespective of, whatever is happening in the macro. But of course, the macro does impact them to, some extent. But going forward, we feel that here maybe, there is a chance that the macros can improve. And then on the other side, there are a lot of sectors wherein there are, multiple tailwinds. So because of, a lot of infrastructure spending, etc., maybe on the renewable side. So, power stocks are doing well. Real estate has gone through they've gone through a bad cycle for almost 14, 15 years. So that is coming out of, bad cycle. So that is doing well. So I think there are multiple pockets this time. As you would have seen, I think the growth is very broad based. It is across, a lot of sectors. Even, auto companies, first passenger vehicles did well. Now two wheelers are doing well. So we feel that, churn or that sector rotation will keep, happening. And sectors that have not been doing well will also, gradually pick up and start doing well. So what we need to see is that, what is being factored, into the prices of stocks in these sectors. Because, there are definitely, pockets wherein there could be a, bubble type valuation, or we don't know how the fundamentals will play out. So if we see that, earnings has a predictability, and we see that, valuations are fair to reasonable, those are the sectors that, we look for. And just coming to the rate cut question. So, I mean, no, again, we analyze companies in a different way. We don't, want to base them too much on various macro events happening, because I think it's very difficult to predict what will happen. And, when the rate cut will come, how much will it come? So, we don't generally like to, base our thesis or buy companies based on that. So it's more to do with what the companies may do irrespective of, what happens in the macro. So that's how we see. And I think, broad based, multiple sectors should do well. I've highlighted a few which, could do well. But if Satish wants to add something, yeah.
Yeah, just to add on the rate cut front. See, overall, when we look at our companies, we look at whether they are efficient or not. So, in any situation, if there is a change which impacts entire sector as such, so the logic says that the most efficient guy will also tend to benefit out of it. So, but we will not base our argument only on the basis of rate cut, because it may happen or it may not happen. We don't want to take that call, and when will it happen? Also, we don't know. We do understand that the interest rates have peaked out, but there are a lot of inputs which decides that what it will lead to. So overall, I feel that our set of companies will also likely benefit if there is anything which benefits the entire space.
Thank you, Satish ji. Thank you, Kshitij ji. With that, we would like to wrap up this webinar. And for more queries, you can reach us at www.aifpms.com, or you can call us at 8368586435. Thank you all. Have a lovely day ahead. Take care. Bye.
Thank you. Thanks, everyone. We hope that we have been able to convey our thought process, and your queries were answered well. If there is any clarification you want, you can mail it to Devanshu and he can forward it to us, and we'll be more than keen to reply it.
Thank you, everyone.
Everyone, for your time. Thank you.
Yeah. Bye.